Good morning, everyone. Hope I'm visible. Okay. So today we have a very interesting webinar on our hands where we're gonna get deep into ESOPs. I'm sure you all have heard about it in the recent. We're seeing a lot of news that so many employees are getting rich. They're turning into crorepathies, lakpathis by just having ESOPs in their hands. But today we're going to see how to manage these ESOPs. Just getting these ESOPs is not enough. It just feels like, sure, I got a lot of wealth in my hand, but managing it requires a lot of skill. So without any further, I'll get started on the webinar. Okay. First, I'll just show that what we're going to cover today. First, we'll just have a basic understanding of how ESOPs work. That is your employee stock option plan, how that works. Then we're going to go deeper and understand the taxation of, well, how the two-stage taxation happens in your ESOPs. Then we're going to go ahead and look at the hidden risks that are there in these ESOPs because ESOP, it can be a major part of your wealth. We need to see how to tackle a situation where it becomes too risky. Next, we're going to talk about emotional bias. So this happens when you're attached to the company. Again, we'll get deep into it and we'll understand how emotional bias plays a biggest role in your ESOP. And finally, we'll tell you how to smartly manage your ESOPs. Now, that is the entire crux of the webinar. I'll do one thing, I'll get started with it. So first, what exactly is an ESOP or your employee stock option plan? ESOP is basically your employer giving you the option to get a share of the pie. So it means that you get to own a share in your own company, which will be provided to you at a discounted price. ESOP gives you the option to buy the share. So let me just a second. Yeah, ESOP has three stages to it. One is it has to be first granted to you. The company has to see that you have been working here for a long time. They have to trust you and they have to grant it to you. It usually comes with a cliff period. So let's say your ESOP granted to you will vest in 4 years. I'll explain these terms. So yeah, there's a 1 year cliff. 1 year you have to stay with the company, after which they'll let you have the share of the pie. That is the shares of the company. So when after a year, let's say it starts getting granted to you, that means you can have the option to exercise it. I'm going to give you an example where the ESOP is a 4-year period ESOP. After 1 year, 25% gets granted to you, or it gets vested. So you have the option to exercise it in order to get those shares. For that, you have to pay an exercise price, which will be on a discounted rate. So that is how ESOPs work. Another element of such a plan of incentive is RSU. Now, RSU is where you don't have to pay the excise price exactly. You'll just have to pay like a nominal value. And in terms of compensation, they'll give you the shares. So over here, you'll get the shares to you right when they get vested. So over here, taxation happens immediately. Whereas in ESOP, you have the option to buy the share. So at that time, you can choose how to plan your taxes over there. So even this has a similar vesting schedule. People often get confused with ESOP and RSU. That's why we have covered both and we're going a little deep in both of these. So in RSU, your taxation happens immediately and it's a part of your compensation. Whereas in ESOP, you choose to either buy it or you can let it go. Next, I'm going to talk about the taxation. So if we look at the taxation of both RSU and ESOPs, there are two stages to it. First stage is the tax at exercise. So let's say you have gotten an ESOP option where the share price of the fair market value of your company is 1,000 rupees, but they give you an exercise price of 100. This is all pre-decided before they give you the granting schedule and everything. So once you choose to exercise it, let's say 1 year is over, you can exercise 25% of those shares. You choose to exercise it. So the difference you see between that 100 and 1,000, that 900 rupees, on that you'll have to pay tax on your slab rate. It'll come under your perquisite tax. So you'll be paying tax of rupees 270, assuming that you're in the 30% tax club. After this, the next stage of taxation comes in. That is the tax at sale. Let's assume you have held it for a number of years, like 5, 6 years, and now finally you have reached your goal. You want to sell the shares of the company. Now you'll be paying capital gain, but your cost will be taken as 1,000 rupees, not the 100 rupees of exercise price. So at 100, you exercise it, and at 1,000, The difference between that 900 goes to your slab. After that, you decide to sell it in the future. Let's say the stock goes up. The difference between the 1,000 rupees and the exercise price, let's say 1,200 in this case, you pay 200 rupees capital gains on the 200 rupees. So that comes to some 25 rupees per share. This is the case for uh, your company's ESOPs and RSUs. Now, each ESOP and RSU category has its own taxation. It depends on whether it is short term or long term. So, what decides short term, long term is your holding period. Now, for RSUs and ESOPs of Indian companies, if you hold it for less than 12 months, it'll come under your short-term capital gains. Currently, it's at 20%, so it'll be tax 20% flat on the second stage, and on the first stage, it'll be as your perquisite. That is your exercise price minus fair market value. That will be your slab rate. And from fair market value to your sale price, that will be your capital gains. Now, for your global ESOPs, most of our NRI clients come and ask us this question only, that how will my global ESOPs be taxed? So global ESOPs have a different holding period. For that, if you hold it for less than 24 months, it will be taxed under your short term. But if you hold it for more than 24, it will again come to your long-term capital gain tax of 12.5%. Another key thing to note here is if those were Indian shares, you will have long-term capital gains of 12.5% and the exemption of 1.25 lakhs, which you can claim. But for global, that might not be the case because it won't be considered as a equity under Indian taxation. Again, global stocks and unlisted stocks in India work in the same way. Well, 24 months is the holding period that decides if it's short term or long term. That is on taxation. Now we're going to talk about a case study that it's a real case study which has happened, but yeah, we have massive numbers. So the client we had was having a total net worth of 10 crores. In that, 8 crores of his wealth wasn't just ESOPs. We had suggested that, sure, it's a very high exposure, 75% to 80% of your net worth is just in ESOPs. That is a very high exposure. So we had suggested to trim it down a little to bring it to a normal levels of say 20 to 25%. That is acceptable. And we had also reviewed the stock as well that they were holding in ESOP, and we did not have a good rationale on it. Let's say we knew that okay, it might not perform as much, and it's not. It will be too risky to hold 80% of your wealth in that particular stock. So he had suggested something, but client was too sure on the company. He had his own personal bias, saying that I see the internal numbers every day. I know my company, which is fair enough. We can't argue with that. But what happened next was the stock fell almost 80% and became his total net worth went from 10 crores to 3.6 crores. The stock had fallen that much. So that's what we are here to discuss, that having most of your wealth in ESOP might erode almost 80 to 90% of your wealth. So being risk managed is very important here. So I hope this case study did open your eyes to see that okay, it is a very risky thing and we need to manage our ESOP smartly. Next. Now, the main thing that we faced with the same case study was emotional side of ESOPs. What happened here was the person is attached to the company so much, since it does make sense because you're working for the company, you're giving your all to it, so you will develop a personal bias where you get attached to the company. Second thing was the loyalty kicks in. People assume that if I don't exercise my ESOPs, if it is not a part of my wealth, like most of my wealth, I'm not being loyal to my company. We need to understand that loyalty is there, but you need to keep it separate from your personal finance because you have to reach your own personal milestones, personal financial goals. You can't let loyalty cloud your judgment. Next was FOMO. So people around him in the company were obviously talking about how great the company will perform, the numbers look good, everything, but nobody was considering how market works. So he had a fear of missing out. That is your FOMO. So he was anxious that if he doesn't hold almost 80% of it, he lose out on a lot of wealth, which he ended up happening even though he held most of it there. Next was overconfidence. Now, since he already saw all the numbers in the company, he was very confident that the company is going to perform. The company can perform. That is not that is a bias that he is having. But again, market conditions can determine how and when it performs. So we need to be very careful on how we risk ourselves for the particular stock. So he had visibility, but he didn't choose safety. That is the bottom part of it. So he knew that operations were working, the balance sheet looked good, everything was going well. But again, investment safety should be your priority. Risk management is where I thought kicks in. Now, again, I'll go a bit more detail because this was a very sensitive case. I really want all of you to understand what has happened here. So all of his eggs were in one basket. We have been hearing this jargon all along that don't keep all your eggs in one basket. So we need to understand that that works for ESOPs as well. It doesn't just mean that if I work for the company, it's going to perform too well. Second one, he didn't have a diversification plan. So in this case, since 80% was there in your ESOPs, only 20% was left to diversify across all other asset classes. So this is not how it should be. You need to diversify all of your investments in order to have a risk managed return. Next was cross-border liquidity. Now, this is where the company was actually a European company. So, because of foreign exchange problems as well, he had foreign exchange issues of bringing the money in because he didn't invest it on time. So there were a lot of policy issues. So that also comes into consideration of when you have to exercise it, when you have to sell it. Then he didn't run a stress test. This is the most important part. You need to always think to yourself, be conservative and say, okay, I have 80% of my wealth here. What if the stock falls? You always need to think about that because everybody will be optimistic about their own company. Nobody runs a stress test on their own ESOP. So what he should have done, he should have reduced his exposure slowly and brought it to comfortable levels of say 20 to 25%. Again, this depends on your company as well. We can obviously review the company for you and give you the right number of allocation that you should be having, an ideal allocation. Then he should have sold it at every vesting event. What he did was he didn't sell it at the right time. Sometimes what happens is if you don't exercise it at the right time, the option goes away. So you need to really sit and read the vesting schedule and understand and plan when you have to exercise your option. Next is building that foreign exchange and liquidity buffer. So what happens is, since I showed you the taxation, you should have gotten the question. Okay, I get the shares, but I don't get any money in hand. So you need to make sure that there is some cash flow ready to pay those taxes as well, because you'll be holding the shares in a paper form. You don't have actual real money to pay it off. So that is one big thing where you need to be ready. And you should run stress tests on your ESOP exposure, as I discussed before. I'll go to the next slide. Now, this is a case where we had the client who listened to our advice. So here, his net worth was around 6 crores and 3 crores was kept in ESOPs. So 50% of his net worth is again tied to a single stock. So we again went through the company's financials, we had a strategy team review it, and we did an audit and we told him that 50% is too much. You can reduce it to say 20 to 25%. And the client was understood the rationale and he was like, fair enough, I'll reduce it a bit. So we slowly started reducing it and brought it down to levels of 25%. The rest 25%, we had it diversified and invested in other instruments to make sure that, okay, he's not too concentrated, things are not too risky for him. So the action was that he did it, and the outcome was that the company stock actually crashed. So we saved almost 1.5 crores of wealth for this client. So again, these numbers should kick in a lot of idea on your end. This is what shows the main concentration. I keep on saying concentration, concentration. This slide should explain why I keep on saying that. Because see, your salary already comes from this one company. And say your bonus is also linked to this same company. Your career, your growth, your future, you tie up to this same company. And finally, you bring your ESOPs also to the same company. So all of your wealth, all of your life is dependent on just one company. I think that speaks for itself that it's too risky. So diversification is really important. We need to understand that personal biases need to be kept separate. We need to sit and review the ESOP and have an ideal allocation. It is a great wealth building tool, but it needs to be risk managed. So we'll give some ideal rules or number frameworks for you. That is, you can generally have 20 to 25% of your net worth held in ESOPs because again, yeah, they will create significant wealth if it's the right stock, if it's the right timing, and if you exercise it in the right manner. Next is the vesting rule. So you need to balance where, say, your vesting cycle comes in. You need to hold some and you need to sell some because you also need liquidity and you need to maintain that 25% exposure. Every year, this 25% might go to 30, 40. You need to keep trimming it down and maintain it at that 25%. And for the rest excess that you get by selling, you need to diversify it. In that way, you look at your entire investments as a whole portfolio, not just having one stock having most of your wealth. Okay, here we have told you some steps that you need to make sure you go through in order to manage your ESOPs. First is you need to know your number. You need to understand how much ESOPs you're holding, how much your other investments are. You need to build a plan kind of for yourself, which is where we can come in. Then you need to set a target. This 20 to 25% I say, every year you need to sit and review it. Okay, this is my total wealth. How much of it is in ESOPs? You need to sit and understand it and make sure you trim it down to bring it back to those normal levels. In all the previous cases, they didn't sit and understand what's happening. They just kept accepting the ESOPs, and that's why it built to like 50% and 80% of their wealth. Finally, you also need to create a sell plan. So after you've seen these numbers, you need to understand that you have to look at the vesting schedule and see how much you need to sell and when do you have to sell it, and plan for your taxes as well. Next is, now I told you, right? So 25% became 30% at a point of time. That extra 5% you need to make sure you diversify into other assets. It may be your bonds, it may be your mutual funds, your real estate, or it can even be in your gold. Then you have to sit with actually your CA or your financial advisor and understand how taxation will work in this case. When you sell, how much tax do you have to pay? We say a CA because we know your entire history and how to plan your taxes. As financial advisors, we can tell you more about the timing, the investment strategy, and how you need to plan this at the right moment. Then you need to keep monitoring your ESOP, and every quarter you need to have a review with your financial advisor and understand that okay, my ESOPs are at the right space. Is it the right target price? Should I still hold it, or should I sell a portion of it and diversify into other assets? Finally, you need to go to your financial advisor and get your entire portfolio reviewed. So here they won't just look at your ESOPs, they'll look at all your other investments and make a financial plan for you where you'll understand that, okay, this is what I should be holding, this is what I should be doing. So it'll give you a lot more clarity on your finances.
So thank you all for joining us on the Saturday webinar. Hope this session was insightful. We'll connect shortly and keep you posted of upcoming webinars. And if you have any doubts and queries, you can always reach out to us. Yeah, thank you.